The dollar is the unit of liability of the Federal Reserve, and you cannot bail out an institution with its own unit of liability. That doesn't make any sense. The mainstream is starting to understand, though they still think it's because they didn't spend enough money. Hey guys, it's Rafi of the Endgame Investor, and I'm loving seeing all the panic start to come in from the edges and reach the center. Slowly but surely, the tentacles of reality are gripping at the throats of the Keynesians, like the tentacles of a Stranger Things monster growing in the upside down and bursting forth to the real world. The financial catastrophe is just around the corner, and it is starting to take shape. First of all, I wanted to thank everyone who's signed up to be my patron on Patreon for as little as $3 a month, where I give biblical commentary on financial topics and monetary policy and government. If you want a sample of one of those videos, there is one in the description below. And if you're interested in signing up for a 2-week free trial of the Endgame Investor, now's the time. First of all, we have this article, which I missed last month, October 5th, by Jeremy Warner. The gilt market crisis was just the first tremor of the brewing financial earthquake. How right Jeremy is. He says in the second paragraph here, are we on the brink of another global financial crisis, GFZ? It's not hard to make the case after last week's shenanigans in the gilts market, which through a localized affair caused by an ineptly handled mini budget and a very particular hedging strategy among final salary pension schemes, looked uncomfortably like the canary in the mine shaft.
So what the fuck are you talking about?
Here's the problem with all these idiots trying to blame the collapse of one or other part of the financial system on some proximate cause. You have a giant pile of garbage that is way beyond the ability of the trash can to contain it. And a slight wind comes and knocks it all over, and now the house smells like a trash dump. So what caused that? Was it the slight breeze? Was it somebody sneezing on it? Was it somebody tripping over a banana peel and knocking the garbage down? No, it's the fact that you didn't take out the damn garbage. So take it out. Deflate, hyperinflate. Either way, it goes away. As a reminder, what happened in the gilts market was that a whole bunch of pension schemes had a whole bunch of gilts that were leveraged through margin loans to get more yield. And then the value of those gilts started falling as the Bank of England started raising interest rates. So there were margin calls on the gilts themselves, and the whole thing started to unwind until the Bank of England stepped in again. That was just one tiny little symptom of raising interest rates in a world that has trillions of quadrillions, or however much it is, of debt and derivatives. Here he says in this paragraph, this change is going to find its expression in all kinds of mini financial crises in the months ahead, many of which we can at this stage only guess at. The danger is that these random fires eventually erupt into a giant and all-consuming fireball.
Just because we have chiseled abs and stunning features, it doesn't mean that we too can't not die in a freak gasoline fight accident.
So what he's saying is we are in a dynamite factory filled with fine flour in which many people are smoking, chain smoking, and waiting for a spark to blow up the entire system. We knew that. I've known that for a very long time, but now they're starting to realize it. In these 3 paragraphs, you can see that he does understand the problem here, though the solution he doesn't quite get. Indeed, he says, it is possible to think of the contagion and structural uncertainty we are witnessing today across financial, economic, and political spheres as merely an extension of the crisis of more than a decade ago. Indeed, there is a sense in which the 2008 GFC never truly ended, but was simply anesthetized by cheap credit and central bank money printing. That's exactly what happened. You had a fentanyl heroin addict who was coming out of it and going through withdrawal. So doctors decided to shoot him up with a bunch of drugs to put him back to sleep. And instead of using methadone to get him over a heroin addiction, they used fentanyl. And so I guess you could call the next GFC, the next great financial crisis, on that analogy, the George Floyd of finance. Ooh, am I going to get banned for that? And now, thanks to Monaco64, I found this article. He is a great resource, and I recommend you watch his YouTube channel every day. Every day he puts a video. He's more prolific than me. He's more prolific than I am. So Ambrose Evans Pritchard, he is an inflationist through and through. He totally does not get the solution to the problem here, which is a deflation of the entire inflation since 1933. But he says, whoops, the central banks themselves may soon need a gigantic bailout. Well, the question is, who bails out the lender of last resort? Who are you going to get bailed out by if you are yourself a money printer? And the answer is gold. Gold bails out the central banks. Only the central banks that have gold reserves, of course. The ones that don't will simply go under, and the currency that they control will go to absolute zero. Because right now, those currencies of central banks that have zero gold reserves are backed by the other currencies of the world, mostly the dollar, which itself does have some amount of gold backing, 100% reserve at about $35,000 to $40,000 an ounce at this point. So you cannot bail out a dollar printer with dollars. That doesn't make sense because every dollar in existence was brought into existence through the purchase of a bond. And so every dollar that exists in circulation today is ultimately owed back to the Federal Reserve anyway.
What the hell is wrong with you people?
The dollar is the unit of liability of the Federal Reserve, and you cannot bail out an institution with its own unit of liability. That doesn't make any sense. If theoretically all the units of liability of the Federal Reserve were to go out of existence tomorrow by being sold back to the Fed, then by its balance sheet, it would still have more liabilities because the value of the bonds on its balance sheet are below dollar-wise what they were when they bought them. So you have all this negative value on its balance sheet. And what is it balanced by on the other side? The only thing left is the gold on its balance sheet. And therefore, all dollars are gone and the only money left is gold, which is functionally what we are going to see. Maybe not in that permutation, but that is what's going to happen. So let's continue with this Ambrose Evans Pritchard article, which gets a little bit of the problem, but totally messes up on the solution. Here he says, ING says the Fed has incurred a paper loss of $1 trillion or 880 billion pounds so far this year on its $8.7 trillion balance sheet of U.S. Treasuries and mortgage debt. Its holdings are trading at an average 7% discount to par value. This is going to be hard to explain to Congress. And here is the nice graph of the Federal Reserve's paper losses as of 2022. These are going to get much higher very soon. The Fed has also racked up an annual interest bill of $170 billion that must be paid to counterparties. And here, Pritchard gets a little bit of the solution, but not completely, and I'll explain why in a second. The Dutch National Bank, DNB, is exploring a revaluation of its large gold reserves as a solvency backstop. If the Dutch are having to do this, we can be sure that weaker central banks in the ECB network are in worse shape. It is likely that gold reserves will have to be mobilized in several states to boost equity capital. The barbarous relic may get its revenge on fiat paper. And so here, Ambrose is talking in so many words about the end game. The mobilization of gold reserves means revaluing them to equal the liabilities on the balance sheet at a higher reserve ratio. The question is, what reserve ratio will that be? What valuation will the market be okay with in valuing gold at to balance the rest of central bank liabilities? And we do not know the answer to that question. We just know that historically, in 1980, that rebalancing went as high as 130% in a monetary panic. Now, a full gold standard obviously means a 100% backing by gold reserves of all the liabilities of a central bank, which are its units of currency. Will we reach 100% this time? Will we go even farther to 150% in a monetary panic? Well, we could say that at least the Dutch central bank is thinking in the right direction, because the other way you could go is by selling your gold reserves and trying to buffer your currency that way, which does work over the very short term by a few weeks or months at most. But then if you have no gold reserves to back up your currency in a monetary panic, it will go to absolute zero. Here is the offending paragraph, and where it becomes clear that Ambrose Evans Pritchard has no idea what he's talking about. He says, let us be clear. Okay, let's be clear. Let me be clear. That was Obama's, favorite line, but he was never clear. or he was lying when he said he was clear. QE was necessary to avert an implosion of the money supply and a second Great Depression after the Lehman crisis. Well, not exactly an implosion of the money supply. It was to avert an implosion of the fiat money substitute supply, to bring in that way the ratio of real money to money substitutes back to a 1-to-1 100% reserve ratio. That's what deflation is supposed to do, to get rid of the lies. But that was not allowed to take its full course. The fundamental policy failure, he continues, lies with governments. Oh, no. This is where he tries to say that the whole thing was just a timing error. They imposed premature fiscal austerity in the US, UK, and Europe before economies had recovered. So what does he say? The problem was premature fiscal austerity. Premature fiscal austerity. So essentially what he's saying is that governments didn't spend enough money.
What the hell are you talking about? Who are you talking to?
They should have spent more. And only after they were done drugging everyone up, that's when they should have gone a little bit lighter on the fentanyl supply. Well, I wonder what happens then. What happens then is what's happening now. There is no avoiding the final collapse of an inflationary bubble, as Mises said. It is impossible. The only question is, are you going to stop it sooner, or are you going to stop it after the entire currency collapses, in which case you don't really stop it. The market stops it by itself through hyperinflation, which is the ultimate cure to everything that ails us these days, at least monetarily. This next article, also by Ambrose Evans Pritchard, is calling for a Fed pivot. What he doesn't understand is that once they do that, fiat currency all over the world will die. So the title to this is Rejoice. We may be very close to Fed capitulation. And here is the offending paragraph. This is nothing like the great inflation of the 1970s, he says. That episode built up over a decade or more. This is a one-off price shock caused by COVID.
What you talking about, everyone?
No, my friend, it's not. These are only structural problems caused by decades of theft through money printing and inflation that are being revealed now because of COVID. But it would have been revealed by something else. It was only a trigger. And so what does Ambrose call for by the end of his article? He calls for the death of all money substitutes as we currently know them. He basically says to Powell to pivot or risk being Eugene Meyer, who was in charge of the Federal Reserve System from 1930 to 1933. So what does he say? Time to switch gears, Mr. Chairman, meaning time to pivot one last time. He doesn't know that it's one last time, but it is. And now let's move to Reuters to show you what the problem is that Ambrose Evans Pritchard doesn't understand. Analysis. Runaway prices have Central Europe on the ropes. So here we have an article that basically says that hyperinflation is already starting to take place in Central Europe. The latest inflation readings, says the article, in the region ranged from nearly 16% in Romania to just over 20% in Hungary, way above central bank target bands ranging from 1 to 4%. Hungarian bread and cheese prices rose by around 70% year on year in September, while sugar prices in Poland have jumped 50%, with some shops running low in the summer on hoarding in anticipation of more price rises. So here you see the pattern of higher price increases in the most basic of necessities and lower price increases if you spread it out across all consumer products. Why? Because the remaining purchasing power of whatever you can get will be plowed into the most basic of necessities as people clamor for survival. And now here is the error that Ambrose Evans Pritchard makes. We have a quote here from some economist, which usually means he's pretty stupid. The quote goes like this: "The longer inflation and wage pressures remain so strong, the greater is the risk that higher interest rates and sharp rises in unemployment are needed to weaken demand and restore price stability." Well, it's nice that he's talking about higher unemployment and weakening demand. Well, why don't you just kill a bunch of people and then you'll have less demand? You could just accomplish it that way. But anyway, the point is, you can't lower demand for basic necessities, my man. You need basic necessities to survive. And so you'll see on any chart that the most basic of goods, the prices do not go down in a recession. The prices of other goods go down in a recession. But once you have people chasing basic necessities and the prices of those necessities going higher and higher and hoarding starting because they're trying to get in front of price increases, then you're already dead. The money substitute is already dead, and it doesn't matter what happens with the rest of it. Let's finish this off. If we're going to go back to the Dutch central bank for a minute and then saying that they're going to revalue their gold reserves, then what happens in that situation when you have the monetary medium of a country, which almost everyone uses and all their savings are denominated in, and that gets devalued in gold terms by, let's say, 10, 20, 30, 40 times or whatever, what happens is that the purchasing power of these people all plummet overnight and they have no money to buy anything with. And so that is the time when the hoarders, the stackers of real money, of gold and silver, mainly silver for immediate consumer needs, and gold if you're after real estate or businesses or bigger things. That's when the real accumulation of real assets is going to begin for the stackers. And once that happens, you don't want to hold on much longer to your metals. Obviously, you want to hold a reserve all the time for posterity, for your children and your grandchildren, etc. However, in that time, in the days and weeks and months following when the purchasing power of almost everyone on the planet gets cut in 30 or 40 pieces, the desperation for a real monetary medium will be so strong that people will be willing to sell you anything for a very small amount of metal. And don't feel guilty about taking advantage. Instead, do it, because at that time, the global economy is going to need a monetary medium, or the division of labor globally will break down. And so, through our accumulation of real assets, by disgorging our hoards of gold and silver, that is how the division of labor will be saved. It's how people are going to be able to afford food, through gold and silver circulating again. And in the initial stages, it will be in physical coins until a few months later, perhaps new substitutes will be formed that will be more decentralized, so that money creators or money substitute creators will be a check on one another. And so inflation will be a thing of the past. This is Rafi of the Endgame Investor, and this is Murray Rothbard.